Happy Saturday morning, folks. Welcome to a beautiful day in Austin, Texas. I have a good video planned for you. I've changed the title 100 times. It's called Wealthy Folks Don't Have to Lose Money, the tale of two retirement strategies. It's also called How to Avoid a Lost Decade. This dude made a lot of money in the dot-com bubble. That's Mark Cuban. He founded a company and sold it to Yahoo for $5 billion. Only problem was he sold it for $5 billion in Yahoo stock. And the other problem was he signed something when he sold it that he had to hang on to the Yahoo stock for a certain amount of time. Well, I believe this was in 99. The market was just as high or maybe higher back then than it is nowadays. People for a couple of years had thought it could crash at any moment. Mark Cuban didn't want to see the billions of dollars he made evaporate, so he protected, or I should say his brokers protected his fortune with a trade called an option collar. We're going to talk about an option collar today and what a beautiful trade it is. The good thing is if you've accumulated enough money to support your family, congratulations. That number is different for different people. You don't have to necessarily make as much as Mark Cuban did. For him, it was probably, if I make more than $1 billion, I'm out of here. He sold his company for $5 billion. He owned 28% of it at the time. So his brokers were protecting, $1.5 billion fortune in Yahoo stock right around the turn of the century. And I could see why they were nervous. Anyway, they structured some trades for a couple of years, and they got him through that time period, saved him hundreds of millions of dollars. You can do that. Nowadays, anyone can do that. That trade, and not only that trade, but the wealth management business, doing stuff like this for your clients with covered calls and with callers and other option strategies, and pretty much birthed Yield Max, Defiance, and some of these other funds, in my opinion. We'll talk a little bit more about that. All right, so let's talk about what a caller is, or let's talk about a real life caller. So let's say this isn't a real person. It's an amalgamation of people I know. But let's say Joe's worked at Apple since the 90s. Congratulations. Joe's 401k has $5 million in it. And that's just in Apple stock. He had a bunch of other stock. He had about $10 million in his 401k, but he lost half of it in his divorce. He also used to have a condo in Pacific Heights, but same thing. He lost that in the divorce. Joe's relocated to Austin. He has $5 million. He's middle-aged. He is engaged to be married to a Texas girl. She has a kid on the way. Joe likes classic cars. He's living his best life, but at the same time, his Apple paper net worth, especially approaching retirement, he really needs to protect it. He doesn't want to go through what's called a lost decade, like people who retired in 2000. Let me give you, so here's an example. Here's a lost decade in the indexes. Wonder if you retired in 2000 with your money in index funds and the market, what I always call generically kind of the market. Well, 2 times during the decade, your money, if you were Joe, for instance, his 5 million would have gone to, it looks like about 2.5 million twice during the decade. And your overall money wouldn't have gone anywhere and wouldn't have started to make money for 10 or 11 years. That's what a lost decade can do. Here's a lost decade in an individual stock. This is a monthly chart of Eli Lilly going back to the inception, 1971. My grandfather worked for this company since the 50s. He retired in 79. His stock was at $3.57, and it went straight sideways until 1984. And that was a rough time in the economy in America also. That was the Great Recession. But anyway, Reagan finally got it straightened out. The economy took off. And then by 89, in another 5 years, his stock, or anyone else that had retired from this company, had 5x. And then another 10 years, it had 10x. But then if, say, a person had retired from this company with a bunch of stock in this company and they were counting on it to retire, and Eli Lilly's a good company, but say you retired in 99. Well, You want to talk, that's a lost 2 decades. It took until 2018 for Eli Lilly stock to get back to even. So that's what a lost, that's a lost decade. Obviously, the Eli Lilly example, you shouldn't have all your money in one stock. Unfortunately, people that work for companies all their life oftentimes do. They don't mean to. They really believe in that company. And or that was a good deal because it's part of the employee stock option plan. My dad told me my grandfather always maxed out his contributions to that, and if he had friends at work that weren't taking their stock options, my grandfather would buy stock options from his friends during his career, and he accumulated them that way. So yeah, by the time he retired, he had a lot of Lilly stock. Well, even having a lot of Lilly stock, if he was counting on it to appreciate, it went straight sideways for 5 years. You have to be ready in retirement. Your stock could go up, but your stock could also go down. You have to be ready for anything. Anyway, we're going to talk about strategies to try to kind of get around this. Okay, so let's go back to Joe in Austin. Joe with the Porsche and the young he's the young wife. Okay, so Joe could do something. He could diversify his Apple. He could sell the Apple, put it in some type of index funds, and use some high yield funds. He could also just put on a collar. So this is the point where I'm going to show you kind of how a collar works in option strat. So a collar has 3 parts. We're gonna dissect it very quickly. One part is it's a stock position. In Joe's case, it's $5.4 million worth of stock. It's 25,000 shares of Apple. For somebody that was a software engineer for Apple since the 90s, that number is not unrealistic. No, not at all. There's tons of people walking around Austin with this much money. In Silicon Valley and lots of places. The software business is a good business to be in. I mean, let's just call it what it is. Okay, so there's 3 parts to a collar. Somebody that has stock, and you can think of it as a covered call. So it's stock plus an out of the money short call. So in this case, if Joe came to me, we could go out till next March, a year from now, sell at 230 strike call on Apple. Apple's only traded into 220, so it's a little bit out of the money. But that option sells for $21. Turn around and take the money and buy the third component, which is a put that's somewhat lower and costs a little bit less than you made on the option. Put costs put costs $13, so it costs $7 less than the option. Joe could do this whole trade for a credit of $203,000, pay taxes, and pay himself about $15,000 a month the rest of the year. That's what he would live off of. This is a covered call and a collar. It's one trade. I just did a collar for a big credit. You guys get the idea. This wealth managers do stuff like this all the time. Jay Pestrochelli, when he was on my show, this is how YieldMax was born. Jay has a wealth management shop, and a lot of other people do. And Jay deals with people like Joe all the time, or people like my grandfather, frankly, that just have their nest egg in one company. Anyway, the collar's one way to alleviate that, or one strategy to deal with that. Now, the other strategy, and we're going to look at this one now. This one may be more interesting to you guys, but Joe could just diversify. He could sell his Apple and, buy index funds, growth funds, and like I say, get a little bit of maybe ULTY, which in my opinion is a really good high yield fund, just a tiny bit of that thing to pay the income he needs, because Joe's considering retiring in our scenario. Like I say, his soon-to-be wife has one on the way, and he cannot really afford to see that $5 million slip to $2.5 million. He's not going to go through a lost decade in his mid-50s. He just can't do that. So the collar would work for him, but also diversification could work for him. So let's talk about that real quick. All right, so I'm going to include this back test in the comments where you guys can download it. But look here, all I did is I went over here to the settings and I set up a back test for Joe's situation. 5.4 million. and he wants to withdraw $15,000 a month, inflation adjusted. Okay, so that's easy to do, and I tested a couple different allocations. I tested 90% SPY, and it could be VU, it could be VTI, it could be Qs, it could be anything. It could be a mixture of them. And SPY is just it's a proxy for growth. So in this case, 90% SPY, 10% ULTY, the high yield fund for low income. We'll see how that does. Well, first of all, the returns it's up 12.7, and this is a past year. This is over the past year. These funds were Alti's only been around for a year, but it paid 12.7, and that's after paying Joe $15,000 a month. It still appreciated 12.7. Okay, well, here's a 95.5, and it appreciated 13%, like we would expect, because it has more growth in it. And right here is 98.2, and that even has more growth in it in proportion to income. And so we would expect even more growth. And this one appreciated over the past year 14.4% and paid $15,000 a month. That's incredible to me. That's an incredible rate of return. But of course, it's been a great year. That a lot of that's due to the SPY's return. Okay, but the reason I showed three different balances, and what I always say at this point in the demo, why do you even have Alti? Why are we even messing with Alti? The only reason we have Alti, ULTY, is because we need that income. He wants to retire. His salary was $350 a year before, and he needs half of that in retirement, $15,000 a month. Okay. He's going to do some consulting and stuff on the side. He'll be fine. But let's see which portfolio gets him. Any of the three portfolios get him the growth he needs. He needs growth. He needs growth, but he also needs income. So we'll look at the income. So portfolio one obviously has the most income because it's 90-10. But heck, that paid $488,000. He doesn't need that much income. We're just looking for $150,000 or so after taxes. Portfolio two, which is the 95.5, pays about $250,000 in income. Pay your taxes. He could pay himself his $15,000 a month with portfolio two. So 95.5 it is. Portfolio three, if he hadn't just remarried the younger wife, maybe he could have done portfolio three. He didn't like classic cars so much. But for him, portfolio two, probably 95.2. So portfolio two will give him his growth. And let's go up here. Portfolio two, he was started the year with 5.4 million, ended with 6.1, appreciate 13.7. And that's after, like I say, that's after the withdrawals. Just comparing it to the Vanguard, to the index fund, just to put it all in Vanguard, it underperforms by a little bit, just selling Vanguard. So that would have done 14%. So yes, this does underperform a little bit, but this is something like I might, if I was still in wealth management, I might recommend. But if he was my friend, and I have friends like this, I might tell him something like this also. You can tell your friend what to do. He doesn't have to listen to you, but this is something similar, something to look at. Okay, so now what I want to show is kind of what not to do. So we're going to introduce one more character. We got Jake, the 35-year-old millennial. Jake's worked at Apple 7 years. He's amassed $500,000 in his 401k, which is really good also. But Jake sees how Joe is living, and he wants $15,000 a month also. He hears that Joe's going to be able to live off of $15,000 a month in retirement, buying this stock with the ticker ULTY. So Jake's considering just maybe a 50-50 split in his 401k, and then maybe quitting his job. Why not, right? YOLO, you only live once. Okay, so let's kind of look at that. I put this scenario in Portfolio Simulator, Jake's scenario. Let's see how Jake did, or let's see if how that scenario, if Jake would have done that a year ago, how that would have done. So I opened up a duplicate tab, and it has most of the same stuff, but just to show you guys what I did up here in settings, it has $500,000, withdraw a fixed amount, and Jake wants to live like Joe, withdraw $15,000 a month. Okay, let's see how Jake would have done. Oops. On a 90-10 allocation of SPY and ALTI, Jake would have lost 22%. Now he is getting the money. He's withdrawing the money, but his account value is down. We'll look at the account value in a second. I also looked at portfolio. I also looked at a 50-50 portfolio. That's really what he was kind of going to have to do because he needs more income with only 500,000. Well, 50-50, he's down 30% on the year. Now he got his income, but how many more years do you think he's going to be able to get his income? I mean, he's lost 30% in 1 year, and that was in a year the market's done relatively well outside of the last month. Okay. So let's see how that would have worked out for him. So portfolio 3 for Jake would have started with 500,000, ended with 348, lost 30%. It's not sustainable. I think you guys can see that. Okay. So, but I'm not just trying to rag on Jake. What's something that Jake, the millennial, could do? So this is a great use case for these funds. I mean, the best use case for these funds. Jake, the millennial, is married to Amanda, the millennial. Amanda's pregnant, but she's a school teacher. Well, she's going to have this baby, and then she's going to stay home and maybe have a couple more and raise the kids. Okay, that we need to replace her $3,500 a month salary. I wonder if ULTY or high yield funds or allocating to some high yield could help Jake out in that case. He may not be able to live off $15,000 a month, right? A big income doesn't come from high yield. The big income doesn't come first. The wealth comes first. Once you have wealth, you can reallocate and you can create a high income. But Jake was trying to put the cart in front of the horse, going for the $15,000 monthly income before he's earned the money. So let's look at, let's go up here, back here to settings. Like I say, I'm going to share these with you, and let's switch his withdrawal amount to a more reasonable amount, $3,500 a month. See if he can do something like that, and then his wife could stay home from work, and she can raise the kids. And they think that's a better outcome for their children. I would agree. I'm kind of traditional in that way. That's the way I was raised. But all right. So the 90-10 portfolio made 7% on the year. That's not bad. The 50-50 portfolio lost 1%, but I mean, it didn't lose 30. This might be sustainable. This is why you would want to talk to your financial planner. A financial planner could go through another level of analysis and run this into a Monte Carlo simulator. But you might be able to get away if you'd be sacrificing portfolio growth, but you might be able to get away with $3,500 a month. It'd be something you could at least talk about with your planner. Let's see if you wanted to maybe do $2,500 a month, if you could have some portfolio growth, maybe replace most of her salary. And this is just how I would have done in this last year. But on a 50-50 allocation, you could even have a little portfolio growth and pay yourself $2,500 a month. So these high yield funds do have use cases and can help out with planning. And they can't really make money out of thin air. Obviously, nothing can. But when you have a situation like Jake or Joe, they can play a part in it. The difference between Joe the Xer and Jake the Millennial is Joe's already earned the money. That $5 million in Apple stock, that cost him less than $500,000. Same thing with the house he's living in, or it's the same math. Anything he sells Apple stock for is a win-win situation. It doesn't even matter, really. Jake could do the same thing as Joe. He could buy APLY, which is a yield max stock, which does the exact same thing that Joe's financial planners are probably doing with him on selling Apple to create an income and everything. APLY does that synthetically. That's or not. They do that. But the thing is, APLY is for people that don't already own the Apple stock. YieldMax creates the stock for you. They synthesize the stock with options. They buy a call and sell a put. They don't even own the stock. Not that matters, but essentially when you buy YieldMax, as good as it is, you're paying a manager to put on a synthetic position sell options against it, and then pay you the stream of income. It's largely the same thing Joe is doing, except Joe's doing it with earned money. Even if Jake isn't on margin, which hopefully he isn't, he's essentially using borrowed stock. It's not an asset he's owned since the 90s that's 10x'd. That makes a big difference. There's influencers like me that are just crazy saying covered calls the best things ever, and it's a win-win situation, blah, blah, blah. Yeah, it is if you already have stock that you own and you have a profit in. It's definitely a win-win situation. When you do a covered call out of the blue on a stock that you don't already have a profit in, it's a tactic, it's a strategy, and it can definitely help. But it's not the greatest trade ever, like the covered call is for the person that's worked at a company 10, 20, 30 years. That's where the covered call was designed, and that's the use case the covered call does best in, is all I'm saying. Basically, yield max is like borrowing stock to sell options a little bit. It's the greatest thing ever if that's what you need in your portfolio. I showed you a case for ULTY, a couple of use cases for it. Greatest thing ever. ULTY just also, incidentally, what's their strategy? ULTY does callers. They do option callers. That's their whole strategy. They have stock, they sell calls and buy puts. Anyway, that's another story. But the caller is a really great and interesting strategy. But be aware, if you're doing these trades with money that you haven't already earned, essentially you're buying stock to sell options against it. Works great as long as the market goes up. But the decay and the erosion a lot of people are talking about is just the AUM, the money coming out of their account when they're over allocated and really can't afford to lose that money. It's just the price. Typically, a lot of what's blamed for decay and erosion is just the price of the underlying, that whatever their yield max fund is selling options is the underline's going down, like Tesla was, or Tesla has been the past, or a week ago, or like Murny, MRNY. That's not erosion. That's not decay. That's just the asset. That's just the stock. You picking the wrong stock. I mean, if the price of the stock goes down, it doesn't matter really. The option income helps and everything, but it doesn't make the ETF immune from losing capital. It does make the ETF a little less risky, but use discretion on these things. These things are risky, especially if you haven't already earned the money. The market's fairly close to all-time highs. It's not too late to buy protection. I know it would have been better yesterday or last week or last month. That's always the case. It's close to all-time highs. If you're worried about a lost decade, if you're in a situation like Mark Cuban, if you're in a situation like Mark Cuban, stop watching this video and go get a financial planner right now. Go get two of them. Get a first opinion and a second opinion. But there are ways that ordinary people that aren't like Mark Cuban, that have made people work hard all their life, and they don't want to see their assets dwindle away. Maybe they want to leave some to their children, or maybe they just don't want to have to worry about it in retirement. Here's a couple of ideas. Okay, there's a whole industry of ETFs that have done exactly what Cuban's people did for him. It's the buffered ETF industry. Calamos and Innovator are two good ones. They're basically in an ETF wrapper of what Cuban's financial planners did. So let's look at. Okay, here's Calamos has some protected Bitcoin ETFs. Let's say a guy wants to invest in Bitcoin, but he doesn't want to experience a lost decade in Bitcoin or something. Well, they have three different levels. You can invest in this one, CBOJ, and it gives you 100% downside protection. You can invest in Bitcoin. It cannot lose money. You can only make 11% on the upside. You can also invest in CBXJ. It has about 30% upside with about 10% downside protection. You can lose 10%. Okay, but this could keep you out of a crypto winter. If you're afraid of a crypto winter, then you have this one CBTJ, and that gives you can lose 20%. They'll let you lose 20%. That's the max you can lose. That's the floor on your loss. But if Bitcoin keeps going up, you can make 51% on the upside. This is Calamos. They also have tons of these things for the indexes and even, well, I think they have those for indexes, and Innovator has a bunch also. Innovator has all different levels of buffer. They have what's called a barrier fund, which is different than a buffer fund. They have accelerator funds, which are interesting as well. They have funds based on TLT, foreign stocks, Russell, NASDAQ. These guys have everything. They have funds that start in different months. Every month they start a new fund. These guys can, I would say, you and your planner look through the Innovator website. It's a good. I mean, you can probably find what you need there. There's a lot, in my opinion. There's a lot of tools there, and they have this thing right here. This is, they call a ETF finder or whatever. You can check what you need. You can check, I need SPY with a 10% buffer and a rebalance. You check what you need, and then it'll give you a list. So you have power, you have authority. You can. That's something you can do. That's one thing you can do is on Monday you could put your growth into one of these type situations and sit this out. I mean, I'm not telling you to do that. I'm telling you to talk to your planner and think about doing that. It's something you could do. Let's just put it that way. But the key to these plans are you have to have accumulated enough money, because once you do something like this, you're essentially cutting off a lot of your growth. But that's why these portfolios are perfect for people approaching retirement in their prime earning years. They have a high level of assets right now, but they want to keep it that way. These are good at preventing a lost decade, or even a lost year. Maybe we just kind of go sideways and grind for a year. I mean, you could also do it yourself. You could do the 1-year collar on your portfolio. If you have a friend like Joe does, you could get a Tasty Trade account, and seriously, you could do a collar for a couple $100,000 credit, put the couple $100,000 in T-bills, pay yourself an income every week with it. Easy peasy. Do that every year in a stock that if you have all your money in one stock, the collar works there. You could also, here's another thing, you go get somebody like Jay, or get a hold of me. I know a good wealth manager. I'd probably send you to Jay or the guy from Accruance Capital. I really like that guy. Accruance Capital is a wealth management shop out of Dallas. But you could also, and especially if you have probably five or more million, go talk to one of those guys and they can do something custom for you. When you get to the higher levels, you don't have to mess with Yield Max and the kind of, cookie cutter things. And still a third thing, and you guys have seen me do this in real time with my family's money. I just don't want to sit through a freaking bear market. And my family invested right at the top. I don't want them to have a bad taste in their mouth on these high yield funds. It's not the problem, the high yield funds. We bought on December 15th, which was essentially the top. And I put them in because at the time the market was going great. Trump had just got elected. Everything was going great. I put them in the NVIDIA, AMDY, all the good high yield funds. Well, how did that work out for me? But anyway, but in my defense, as soon as we got in a bear market, I allocated to have some inverse exposure in there also. So YQQ is an inverse fund that's inverse of the NASDAQ. That gives you inverse exposure. You could also use fiat, which is inverse Coinbase. You could use DIPS, DIPS, which is inverse NVIDIA. There's also Crash, CRSH, which is inverse Tesla. Then there's also funds like XMAG. XMAG is a growth fund. It's an index fund. It's made up of the S&P, S&P 500 minus the MAG 7. So it gives you exposure to the whole rest of the index, which won't prevent a lost decade, but it can maybe help give you some diversification. It kind of help lower some risk in retirement. There's also funds that they call them equal weight funds. There's one called QQEW, which is the equal weight Qs, and it's funds that instead of cap weighted, you just get an equal share of every stock in the index. It gives you a more representative, broad-based cross-section of what the economy's doing, rather than these cap-weighted indexes that we trade so much and that so many high-yield funds are based on, which gives you a very focused view of the economy, which is, what 5 companies in Silicon Valley are doing. Now, granted, they're the 5 biggest companies that are running the world and everything, but still it's somewhat of a myopic view of what's actually going on. So that's another alternative. These are great things to talk about your planner with. If you're approaching retirement and you've already made an amount of money that you're somewhat happy with, Calamos and Innovator can work. If you're in your 30s and you just think we're going to have a bear market for the next year, yeah, you could do Calamos or Innovator, but to me, they're a better use case for somebody that's older, because when you do these when you're younger, you're going to cut off too much of your growth. When you're younger, if you're 30 or you're 35, you're working right now. If you're lucky, you are. The economy is still good. You're working. Just as the bear market happens, just keep buying. Every time you get a paycheck, buy index funds. That's what I would do. And then that's another defense too. So you're buying on the way down. You're only 35. By the time you're 40, 45, hopefully the market's recovered. You've bought at a lower price. Everything's fine. When you're 55 or 60, you may not have that luxury. Our friend Joe, that 930, that turbo Porsche, it needs, he's fixing to rebuild the engine on that thing. That's going to, that car's going to be a show car, but needs to put a lot of money in it. So like I say, the wife has one on the way, but these are all things that a financial planner can help you with, or you can help yourself with. You can study all this stuff yourself. Seriously though, join my Discord if you like talking about this stuff. We talk about this kind of stuff and other stuff, a bunch of option strategy talk in Discord. It's free, and I'll post that link. I appreciate you guys being here on this beautiful Saturday morning. I don't know about you guys, but I'm going to go do something productive and fun with my weekend. I hope you guys do the same thing.